All right, everyone. So I have my really good friends, Kenny and Crystal here. They're my go-to loan brokers for both multifamily and 2 to 4 units, residential, you name it. So yeah, to start, I just want Kenny and Crystal to introduce yourself and kind of tell the audience who you are and what you do.
Sure, awesome. My name is Crystal Moore. I'm the broker and owner of Pacific Shore Capital. I've been doing multifamily and commercial financing for 17 years now. Hard to believe, I feel old. Um, but we also do own apartments ourselves. We own some industrial. We previously owned a property management company. We managed over 1,500 units here in San Diego. We sold that in 2017. So we have the experience not just of the financing, but everything from being an owner to management, rehab, repositioning properties, you name it. We have done it over the last 17 years. So,
My name's Kenny Simpson. I'm actually Crystal's husband, just with a different last name. But I've been doing 1 to 4 unit financing for 17 years. Crazy. Crystal and I combined have probably done about $2 billion of business, just so you have that kind of perspective. To add on to that, yep, we're just active real estate investors as well, and owner operating. And the only thing I'd add on, we do own vacation rentals. So if anybody has questions about that, but I think the value we can bring to anybody, especially if they're experienced or first time buyer, maybe you're looking to get into real estate, whether you're buying a single family residence or buying a 2 to 4 unit, is we have a lot of experience, and we can not only do your loan, we can also advise you in many different ways as well.
Got it. And you guys specialize in two different types of loans, right? Can you elaborate on that?
yeah, so there is a difference for us. I think most people may have some experience in the residential side, 1 to 4 units, and then anything that's 5+ units is considered multifamily, and the financing is quite different on those. So, I talk to people all the time about, that are looking to break into apartments. I think the first thing that they also want to understand is the financing and how that's going to work, because it's not as straightforward as, you can get 75% loan to value or 70% loan to value, whatever it is, on like a 2 to 4 unit. There is a very big difference in the financing for 5+.
Yeah, so 1 to 4 is it's kind of more straightforward. It's you got to qualify. We look at credit, income, assets. The good news is that if you do buy a property and it didn't cash flow because the rents are under, we do not lend off of the cash flow. So if you make enough money, you can actually get 25% down. Unlike Crystal, you could be buying a beach property and have to put 40% down or 50. So that is a difference. Also, the difference about us is most people typically are locking into a 30-year fix. We have 30, 15, 20, and so longer term fix. There's no prepays, and the cost is probably a little bit less because appraisals and things like that are different. But otherwise, I would say just a little bit further into this is that when you are trying to do a cash out refi and investment, sometimes the commercial can be better because we might be capped on the cash out, and then you kind of get dinged too with rates and stuff when you go cash out. So it is two different perspectives. So if you're diving in and looking at each, it is good to talk to a mortgage advisor, like somebody like that, so you can really present a scenario. We can give you back proper feedback and pricing and stuff.
There's pros and cons to both, for sure.
Yeah.
Just understanding that.
Got it. And if someone's looking to just get started and buy their first investment property, do you think it's better to start in residential or to start in commercial?
I think it depends on where you're at financially. I think one of probably the biggest challenge into getting into apartments that I notice with people is that they have a finite amount of money, right? Like they only have a certain amount to invest. And so that can be tricky when you're trying to get a loan and, you're looking at different properties and the down payments are larger than you anticipated. So then what happens is they end up having to reduce the amount, the price that they can qualify for, what they can buy a property for, and then they end up buying a 2 to 4 unit because that's where they have to start. So I would say buy as big of a property as you can to get started. That's what I would do and what I suggest, but it might end up being still a 2 to 4 unit if you don't have enough cash to put down.
Yeah, I would just jump on that is that with us, we don't have it. With 2 to 4, there is no net worth requirement. With Crystal, there is too on top of that. So just because you might have cash this or that, and I got $1 million down, and you want to go buy a bigger building to cover the loan up. If you don't have that net worth, it's a problem. So with us, there is no net worth requirement. You could just put down the 25%. that's really the difference. But typically from owning, operating, we're a believer, as you know, Jason, the more the better. So if you're going to buy a 2 to 4, I would push you to buy a 4 rather than a 2. If you're going to buy 5+, buy as many as you can.
Yeah, I mean, and it's kind of the general theory of the more units you have, the more tenants you have paying your expenses. So if you have a 4 unit and one person vacates, then you have 25% vacancy. You might break even, or you might be a little bit negative when that person leaves, and then you have turnover costs and more vacancy loss. Whereas if you own a building with more units, if you own a 10-unit building, one person vacates, you only have 10% vacancy. I can almost guarantee you're still going to be cash flowing as long as you're not super under rented, even though one person vacates. And you'll probably be able to use that cash flow to put back into the unit turnover and to get it ready to rent again. So that's really the biggest reason I push everybody to buy the biggest building they can, is because we're all about cash flow when you're investing, and it doesn't feel like a good investment when you're having to put money into it constantly.
It's really good. And how about location? Do your clients care a lot about location when they're first looking to buy a property?
It depends. Yeah. I mean, location for me, I say it's hard, because I think a lot of new investors come in and they want to buy a property that they would live in. And that is not the right way to look at it, because, depending.
They're emotional.
Yeah. I mean, depending on where you're going to buy, like, let's say, for example, what I see a lot is, let's say you want to buy a property by the beach. Like, that sounds great, right? I'll own this beach property and it's going to be fabulous. Well, now you got to put all this money down. It's probably not going to cash flow unless you put a huge down payment down. So it depends on what your strategy is. So if you want cash flow, then you're going towards C neighborhoods. If you're looking for maybe, like pride of ownership, then you're going to go to some of those more expensive neighborhoods. But most of us starting out are doing it for cash flow purposes. So location certainly does matter. And I think once you start your search for properties, you quickly learn the areas that you need to be buying in. And they're not the sexiest, but I love cash flow, and that's what we're all looking for. And the C neighborhoods are where it's at.
Yeah, I mean, it's kind of funny. People come to us, and I always have that initial conversation like, oh, I'm looking here, and I don't say anything. And I go, what are you trying to do? What's the budget? And it's, I can't find anything. And I'm like, okay, are you ready to listen? Because you're looking in all the wrong places, And so I'm like, what about here and here? Next thing you know, they get a deal. And I just think, like Crystal said, people are so focused on, I love the street, this building's perfect, it'd be great long term, and this and that. And I'm like, like we always talk about, when you're buying a property too, is whether it's your first or your fifth, is you should have some like expectation, like what's the game plan? What are we trying to do here? And you should be advising, Jason or even your loan officer, because Crystal says, oh, you're going to buy this and maybe rehab and fix it, and you're going to sell in 2-3 years. Well, that would determine what kind of debt you put on it. Did you have a prepay or not? So really, like, I really tell people, your first deal is really about mindset. It's like, don't be emotional. It's really hard, because the neighborhood you're going into, maybe it's not the ideal place, but also in 5 years, it might be the ideal place. You're getting there early. So I just think a lot of people are like, I want to be by the beach, I want to be this. But like Chris said, but when you start really becoming a real estate investor and doing a few deals, you realize that's actually not the place I want to be, because it doesn't really make any financial sense, And so most people land on that in their own mind, but unfortunately, some people learn the hard way.
Yeah, it's funny for me. I love real estate because it all comes down to numbers. Like, literally, you just do the numbers, and then this is a good deal or this is not a good deal, and the numbers are very different in those two neighborhoods.
No, for sure. If there's one big difference I've seen between an investor who owns a lot of units and an investor who owns maybe 10 in their whole career, is that the person who owns 10 units their whole life has way too strict of criteria and cares too much about location. And that the investor who owns 5,000 units or 500 units just cares about the numbers. They don't care about location. So I 100% agree with what you're saying. And it's crazy, because some people just, what Crystal says, they care about a property so much that they have to live in it for it to make sense. And if you look only in Pacific Beach or La Jolla, you're going to have a very hard time cash flowing. So, but stepping back, Kenny, you mentioned about the prepayment penalty. Can you elaborate for someone who doesn't know what that is? Because when I first started, I had no idea what a prepay was.
Yeah, Crystal can kind of break it down, but So when you buy, like for residential, 1 to 4, usually you shouldn't have to worry about it. There's very, very, very few lenders that would have it. And if you're going there, they'd probably mention it and it's maybe a private bank or something. But typically with Crystal, the commercial, you're gonna have a prepay. And it's amazing how some people, they just go to a bank, they buy a 10-unit building, they get debt on it, they focus on that. Oh, the interest rate was so good. Nobody walked them through it, and they get referred to Crystal 3 years later, like, hey, I want to refi, and she's like, well, you're in a 5-year prepay. They're like, what? What do you mean? She's like, yeah, what's the prepay? Well, it's $40,000. Are you kidding me? Why didn't the guy tell me? You didn't review this? So this is why it's very important. Like, Jason, just for like you, what broker are you working with? Who's your mortgage? Who's on your team, right? Are they advisors? Or are they just like, here's a deal, the next deal, the next deal, the next deal? So this is why I said is, what is the game plan you're trying to do? You need to tell your agent, tell your loan officer, but tell everybody, even the property management, whatever, so they know what is going on. So prepays are, if you pay the loan off early, there's a prepayment. I'll let Crystal elaborate on the different types of prepays, but
yeah. So I mean, the standard prepay you're going to see on a lot of these deals is going to be a step down prepay. And so for example, sometimes, like, let's say you go on a 5-year fixed, it might be a 3-2-1 prepay, or maybe it's even a 5-4-3-2-1 prepay. What that means is that for each of those years incrementally. So for example, in the case of a 3-2-1, it would be 3% of the balance at the time of payoff if you pay off during year 1, 2% in year 2, and then 1% in year 3. And then after that, it drops off. So it's those numbers represent a percentage of the loan amount by year for each year until it burns off. So it's definitely something to consider. I mean, that's one of the things I tell people that are so rate sensitive. I mean, if you come from residential and you're just really rate focused, when you kind of step over to the apartment side, it's not just about rate. It's really about prepay, cost, rate. Like it's really about a lot of different variables, because now you have to think about this. Like 5+ units, this is considered a business. So that is the biggest difference between a residential 1-4 and 5+ units. This is considered a business loan. And so these loans are for people who are, kind of believed to be more savvy business people. So it's just a little bit more complex than going the residential route.
It's a great answer. I feel like a lot of people who are looking at loans, especially on the commercial side, they're very one-dimensional. They care about the rate and they care about what the loan amount is, right? But I feel like with commercial versus residential, there's so many more aspects that matter, such as the property P&Ls, the debt coverage ratio, all that stuff. So that's why I think it's really important, and I want the audience to understand how important it is to have a loan broker on their side, whether it's Kenny or Crystal on residential or commercial. I've just seen, Kenny can give a great example of our client who bought that fourplex on 49th Street, Kenny,
yeah.
about how important it is to have you on the team, because I feel like some people want to go the cheap route and go direct to a bank, go to Wells Fargo or Chase Bank. But number one, they won't get the best deal. And number two, you won't get like the stellar advice that Kenny gave and to push the loan through, because you did a lot to get that loan through, and that transaction was horrifying. But if it wasn't for you, if it wasn't for you, that deal would not have closed. So can you just talk like a little about that, just to show people why having a good loan broker on your side is so important?
Yeah, and I want to give you guys a story about prepays, not the caveat, but this is a good story. So there's Crystal and I, obviously, we have a podcast. I follow a lot of people that podcasts. So I follow syndicators. So there's this guy, he's like the rate guy, right? And so he used to work at secondary markets and all these companies. So he has his own company. It's JP Conklin. And so what he does is when, like you said, when people are buying $50, $100, $200 million deals, they actually hire this guy as an advisor. So what he does is goes in, should we do a float rate? Should we do this, that? Because people are spending, they're getting $100 million loan. It could be a big monumental mistake. It doesn't matter if that, but even on a small scale, it could really screw you if you have to sell or refi. So what happened is these guys went back on this one client of his that they sold 40 deals in 10 years. Big syndicator, big. They went back and did the numbers. They did all 10-year IO Freddie Mac yield maintenance prepays. I think the guy was like sick to his stomach. I can't remember, but I think they paid like $40+ million in prepays. 50. It's some crazy number. So what that means is, my point is why do these big guys have advisors? Because they sat down and said, wait a minute here. The market's changed. What's going on with rates? Is there anything else we can do? So we thought we were going to hold these properties for 10 years. Like everybody says, I'm never going to sell. But you know what? That's not the case, because another deal comes along. You call Jason, I got this deal. How do I buy it? We got to exchange up. You got to sell. And so these guys held 3 to 4 year average. They weren't even 50%. So they realized we need to start doing buy out the prepays, shorter prepays, do a float with a cap. So it's the same thing like that, or it's you're going to Crystal, you're going to me for the tough deal. You walk into Wells Fargo, you walk in bank, there's nothing wrong with them. They're really good at banking. But it's a revolving door of people that work there that are loan officers, because what happens, and I'm just being really transparent, is people that work there, the loan officers aren't paid very well, and it's just a big assembly line, and it's like that guy that does your loan, he has to call 7 people to get an update. It's kind of a nightmare. He's not going to tell you that when you walk in there, but this guy could have started a year ago or 6 months ago. So then you compare somebody like me that's been doing this 17 years. I have a team. I can pick up the phone. I can call an underwriter. I can go through the file. I can even coach an underwriter and say, no, you're wrong. This is how we need to get it done, because I have the experience to do that. So really the difference is it's all about experience. So if the guy at Wells Fargo has 17 years of experience and he's done $1 billion of loans, he's probably really good at his job. But if he's 6 months on the job, just came out of college, and's never seen a file like this, he's probably going to screw it up. And when the underwriter says it's denied, he doesn't have the wherewithal or the knowledge to go back and explain to her and present it, say, wait a minute here, you didn't look at this correctly. And that's what I do, whether it's for that client or a lot of other clients. So there's a lot of times I get a suspense or a denial, and the underwriter just doesn't understand the income, because there's complicated, tax returns or this. So I'm really good at tax returns. I'm really good at self-employed. I'm really good at real estate investors. A lot of it thanks to Crystal for referring me her clients. But what's a tough file for 95% of everybody else isn't for me, because me and my team are built for it and we are trained for it. We do it all the time.
Are you going to go through the 49th Street? What was the challenge there?
No, the challenge was, you have somebody that's self-employed, that has foreign income, that has foreign assets that moved it here, that move money all around, that really didn't know that you shouldn't do a lot of these things. But what I had to do is just keep going back and explaining that. And then they decided to audit the file too. So everything you could hit me with is this file. They literally were like, did not want to do the file. But at the end of the day, I get on the phone with the head underwriter. And when I walked her through it, she says, it's not as bad as it was, because a junior underwriter got it, then another underwriter. By the time she got it, it looked like a pile of rubble. And when I can put the pieces together and present to her and say, hey, look, it's foreign income. I presented everything. Here's the other income. Here's the assets. Here's this. They had a lot of information wrong. When I present to them properly and I explain it to them, it all makes sense. And she goes, okay, this is a doable deal. Check, let's do it. And, it did take us months to get there, because the audit took a month. But by the time she got the file, went through and talked to me, it literally took us 3 or 4 days to get the thumbs up and let's get it done. But I wasted 2-3 months with the wrong people. So it's literally, that's what it is. So it doesn't matter if you're self-employed or real estate investor and stuff. A lot of people walk into banks and they're told, oh, you can't get a loan. We can't help you, this and that. I hear it all the time. I hear it on ads. I hear it on the news. It's completely incorrect. Those people don't live in our world. They live in, I listened to, the news, and they said they're not giving loans out to self-employed people. I was like, well, that's interesting, because I just funded 20 loans last month to self-employed people. So I think just having the right information and data too is important.
Crystal, you want to elaborate on that?
Yeah, I think too, the biggest thing for us is just presentation is so critical. That a lot of times if you're going directly to a banker, that you as the borrower have to present all of the information and just kind of transpose that and submit it. And a lot of times, the problem is that once an underwriter sees something, they can't unsee it. Like, that's the big thing. You give them something that's the wrong piece of information, they can't say, oh, I'm just going to pretend I didn't see that information, take it back, I don't need it. And so that's the biggest thing for us, is that we're constantly strategizing on some of these files. Like, okay, how do we need to present this information in the best light so that they're going to understand it and it's not going to look as bad. I mean, the majority of the stuff that we get is just thrown at us and people don't want to do any paperwork, and we kind of put it all together. I kind of prefer to do it anyways, is because of the presentation. So that is the biggest thing about getting the deals through. And that's what Kenny's saying, is just a lot of times with the banks, they get these easy cookie cutter deals. They want the like W-2 person who's like,
One home, let's go.
They own a house and that's it. But once it gets complicated, I mean, Kenny just closed a residential loan from my client that has 70 properties. 70. I don't think the underwriters particularly love that he gets these deals, but they have to underwrite them.
Yeah.
But for me, like, these are the kinds of things that we're doing because it's like nobody else is going to touch your file. In fact, he went directly to a bank and they're like, oh no, we can't do that. So, I mean, these are the kinds of files that we're used to seeing. Of course, we love getting ones that are not that complicated. But when that happens, we know exactly how to look at it, and we know the guidelines too. I mean, Kenny has on a regular basis showed underwriters guidelines that they didn't even know existed to get deals through.
Yeah, so. And I'll say this too to elaborate, because this is really important. When you go to a bank, the LO up front, unless he's really experienced, just going to take your file, put it together, and just submit it. And it goes in there, and like Crystal said, it was presented wrong, and you throw crap against the wall, you're going to get crap back. So what I do when I have somebody complicated or they're not sure, or look, if somebody comes to me and they're in a 1031 exchange, or people don't know what that is, we can talk about, and they have $1 million on the line, that's a liability for us. And you too, Jason. If they don't make that, they're going to pay some taxes. So it's my responsibility as an LO, that's how I take it, to deliver. So if somebody, I'm not sure, what do? I get the information, I call an underwriter, maybe I send them stuff, maybe I go through it, I know what the questions, and I get everything worked out. They said, yep, this is how you need to present it, this is what we need to see, what we get, or hey, this is going to be a problem, you do this. So before I submit it, we have that conversation, and then basically when I get the file and you get it approved, that's why, because we take the time, effort up front. I don't want to submit a file for you, me, or your client that's going to waste all of our time that's not going to get done. That's not good business for anybody. And also, it's frustrating for a client that's like maybe on their first purchase for an investment property. It's not a good feeling. So I don't know. I just think it's very important to who you're working with that's taking the time and effort and really understands what in the hell they're doing.
Yeah, no, that's huge. And one big example I want to give out is with Crystal, one of my clients who's in an exchange, newer client, haven't worked with him before. He's looking to buy his first 6-unit property in Golden Hill. And I consulted Crystal and Mitch about it probably within the first day we had it in contract. And I told them the seller's very tough. He's tough to deal with. His contingency time frame is 17 days and to release money, non-refundable, 100K, no matter what. Doesn't care if the loan's approved or not. He didn't care at all. He was a tough seller. And within 3 days, Mitch and Crystal told me, like, boom, this file looks great. He's a good borrower. The appraisal will come in at value. It's a good deal. So having a loan broker, as a broker myself or as a client that I'm helping, it helps everyone to have a good advisor like Kenny or Crystal to advise you on the deal. So that's just what I have to say about that. But do you want to elaborate on that, Crystal, on how that happened?
Yeah. I mean, for us, this is the thing. So that's another one of those areas in multifamily that can be a little bit scarier for people, is that you really don't know if your loan's approved until right before you get loan docs. So like, on residential, you get approvals on the front end with conditions, and on multifamily, you literally get a letter of interest that is not a promise to do anything. It's basically like, we think we'll give you these terms. And then you give them money and you pay $2,500 or $3,000 or whatever it is for an appraisal. And then you wait 2 or 3 weeks for that to come in. And then they send it to final underwriting and give you their commitment letter, which now says, okay, we'll do the things we said we will, or we're going to do this instead of what we told you we would do. And then you get loan docs maybe a week later. So that is the scary part generally. And with your client, especially it being his first purchase, you need to get the reassurance as much as humanly possible on the front end. So what we do is say, hey, look, I know you can't give me a commitment letter right now, but I have all of the tax returns. I have the bank statements. I have everything that you need to say this file is approved pending the appraisal coming in. So we were able to do that. It's not something that's a standard course of business. But the other thing is that when you have high volume with lenders, it also gives you more weight to be able to get exceptions on the process and to get things done. So our volume with this particular lender is high enough that, we've closed, tens of loans, 50, 60 loans, whatever with them. They're like, okay, you're a good broker for us. You always bring us the good deals. That's the other thing too. We just got it today. We had a lender email us that we submitted, a deal, and he says, well, I haven't fully underwritten the deal, but you guys are always on the spot with your numbers. So, here's what we can do. And it's like, okay, well, that's cool. We normally come in right around the appraised value on our analysis. And then even with qualifications, we've just gotten to the point where I actually look at the information, we pre-qualify it before we submit it. I don't submit something that I don't think can be approved. If it can't be approved, then we strategize on how to get you there before we submit. So in this case, we were able to do that. And in fact, we were able to get the appraisal done a lot more quickly than it was originally slated for as well. So he was able to get that reassurance before removing contingencies.
And you have great relationships, Crystal, too, like long-term great relationships, not just with bankers, but chief credit officers know you, CEOs know you, big, small banks. I mean, we have great relationships. We do loans for some of the people that own, they're CEOs of banks, so that's the thing that's the trust, so relationships, as you know, Jason, are really important too.
For sure. And then my next question for you guys is kind of switching from the lending side to more the investor side. You guys obviously own units yourselves. I know you own a big building in National City. As an investor, what are some things that you look for personally when you're looking to buy a property?
So for me, it's funny because I think depending on where you're at in the market has kind of had us shift our strategy. So early on, when we were first getting started, it was all about really kind of flipping to build up enough cash to buy bigger buildings. So we were always looking for value add opportunities. So a lot of times we were buying a property with private money. We would even a lot of times vacate the building, do a whole rehab on the building and re-rent it, and then maybe hold it for a year or so and then just sell it. So we're not true flippers. But we use the kind of BRRRR method. We use that, buy, renovate, refi, whatever. We did all of that. So that was our initial strategy. And then a couple of years ago, I started just feeling like, hey, I'm not a flipper. I'm not that's not my career. So I'm not the person who's going to go buy these deals and have really skinny margins. That's just not me. I think that a lot of those rehabs were getting a little played out. Every unit's looking exactly the same. And, everything was kind of just the same. It seemed like it was getting a little saturated. So then we shifted and we said, well, we have a decent amount of cash to go buy a bigger building. I want cash flow now. So now we're looking at properties for cash flow because I'm not buying 10-unit buildings anymore. Now I bought my 30-unit buildings. This is great. The cash flow is getting a little more attractive now. It's not $1,000 a month. It's 10, 15, somewhere around there. So now it's about cash flow. So it really just depends. I always say it's funny because a lot of people look at these big apartment owners and they try to emulate what they're doing. And for me, I say that wasn't necessarily their strategy when they first got started. They have the strategy today because they have bigger problems, bigger things that they're solving for. They have to buy a certain amount of properties every year not to pay tax. They need tax write-offs. They have to keep going and being active. That's why they maybe start buying. And also cash flow.
Kenny, you got anything to say? It's all great stuff. And the reason why San Diego is such a great spot to buy, in my opinion, I'm sure you can agree, is the rents keep going up, right? There's always demand. There's always people trying to come down here to live in San Diego. I mean, I have two friends from San Francisco who are, since COVID, have been remote. They worked at Salesforce and now they're down in Pacific Beach. And they said finding a place here was impossible. And rents just keep going up. It's not stopping anytime soon. So if you're an investor and you think the long game and you buy now, prices may seem high, but in 10 to 20 years, rents might be double than what they were. And now you're sitting pretty and you have a 10 unit or a 20 unit in San Diego where things just keep going up and you're buying California real estate. So you're always going to have appreciation. Your rents are going up, you have tax write offs, and you're paying down the loan every single year. So it just seems like a no brainer to me. I mean, can you guys agree on that as well? I agree, 100% agree. That's very well said. And if I think we've given enough, I think we've given enough reasons on why someone should invest in San Diego. So,
The
I'll
best.
just, so, so, so if I'm listening to this video and I've never bought a property, how would I prepare myself to buy my first 2 to 4 unit or five unit?
I mean,
Yeah, it's a fact. And I always wanted to ask you guys, what was your why on why you first started buying investment property? What was the first property you guys ever bought? Ooh, it's a good line. Well, it looks like we're running out of time. I want to make sure people know where they can find you when after we leave here. What's the best place to find your guys' information if someone wants to reach out to you? Got it. And you guys have a podcast too, right? Got it. Well, hey, thank you so much for your time, both of you. And this is a lot of fun and a ton of value. Um, I'll probably talk to you guys tomorrow about our deals that we have going on. So
Yeah.
I'll talk to you guys soon.